Hello and welcome to FidelityConnects. My name is Cam Chamberlain. I'm Director of Portfolio Solutions here at Fidelity, standing in today for Pamela Ritchie. Average loans are currently trading around 95 cents on the dollar, the lowest since November 2023, and our next guest sees opportunity in the discount. Still, it's not a market without its challenges. Investment sentiment is mixed, volatility has crept in, and there's a wide dispersion in pricing. But that's exactly where Fidelity's deep research and active management can shine. So what role can loans play in portfolios today? And how is our next guest looking to history to navigate the current landscape? Well, joining me to unpack the state of the loan market and what it could mean for investors right now is Fidelity Portfolio Manager Eric Mollenhauer. Eric co-manages the Fidelity Floating Rate High Income Fund and is the loan's fixed income sub-portfolio manager of Fidelity Inflation Focused Fund. Welcome, Eric. Thank you for joining us.
Thank you.
Well, Eric, I know that it's your first time on the show today, so maybe we could start just unpacking a little bit really what leveraged loans are and how they differentiate from high yield bonds.
Sure. So they're similar in many ways, but different in a lot of ways as well. So just like the leverage, like the high yield market, we're about a $1.3 trillion US dollar market. We lend to companies on the non-investment grade side of things. So we're looking at companies from BB up through CCC. We lend to a lot of companies, private equity firms, love to use the leverage loan market for leverage buyouts. Companies like to come to raise money to expand their services if they want to build a plant. What's different about us versus high yield is that we are typically secured. Our loans are secured by the assets of the company. We're first in line in the capital structure. So in a restructuring, we tend to get paid out first, and then the junior debt and the equity get paid out before us. So there's some benefit from the security in the leverage loan market, where the high yield market tends to be an unsecured market where you're not secured by the assets of the company itself. The other difference between the loan market and the high yield market is that our coupons are floating rate. So the way we get paid is we have a base rate of just on average, it's 1 to 3 month SOFR. And then we get paid a spread on top of that, and that's our coupon. So the combination of the spread plus SOFR is what we get paid. And the nice thing is when rates are going up, we get paid more because that base rate goes up. When rates are going down, we get paid a little less. So there's not a real duration impact in our market. So we can benefit in times of rising rates and that sort of thing. But we tend to be driven by the same things as the high yield market. You know, good economy is good for levered credit. Bad economy is bad. A lot of companies will have crossover. They'll have both high yield bonds and loans, and some will be loan only type issuers. But it's a really interesting market. I think it's a very misunderstood market. And as a result of it being misunderstood, I do think there are some inefficiencies in the market that we have been able to take advantage over the past, 15 years or so and continue to do so.
Well, and I'd love to talk a little bit more about that and kind of where we're coming from. The last few years certainly has been a better time to be a floating rate investor as rates have come down fairly dramatically and put pressure on the rest of the fixed income side of a lot of multi-asset portfolios. Could you maybe walk us through what that experience has been like for the market and kind of bring us up to the moment and what we're seeing today?
Well, I would say the opposite has really happened, is that short rates have actually gone up. Like for a while in floating rate land, since our base rate was, before LIBOR went away, it was LIBOR, and for a while, LIBOR, 3-month LIBOR was at like 25 basis points. So we weren't getting much of a coupon on top of our spread. And as short rates have risen over the past few years, investors have started to flock towards leveraged loans because we benefited from that increase in coupon and plus our spread. So relatively speaking, we've done better than other asset classes have over the past few years. What we see today is, there's been a move to higher for longer, or that the decline of those short rates has taken longer than many people would have thought. So a few years ago, people thought short rates were going to, or last year, people thought short rates were going to come down. They didn't. and we've kind of maintained that base rate coupon, which has made loans look relatively more attractive to other asset classes as well. So today we're looking at a market where our average spread, we get paid around 330 basis points on an average spread. If you look at buying those loans at 95 cents, a discounted spread to SOFR, we're getting about 440 basis points over SOFR. So with SOFR at, a little over 4%, we're getting like an 8.5% type coupon for senior secured paper, which to us looks pretty attractive relative to other options out there. Did that answer your question? Does that make sense?
Absolutely. And I know it's been a little bit shakier from a market dynamic standpoint over the last few weeks, a lot of tariff headwinds. Does the volatility that you're seeing present opportunity to you now?
Yeah, I mean, the photo that was being played was me pre-Liberation Day, and now you see all this gray hair in the beard. And so yes, the volatility has been very interesting in the loan market, and it just like, equity investors have been stressed out over this, high yield investors have been stressed out over this. We've been stressed out over it in the loan market as well. What I'll say is that I've been running loan portfolios since 2007, and we've seen all sorts of things happen. We've seen the financial crisis, we've seen COVID, and now, Liberation Day is just kind of the next thing in line. After 30 years of doing this and being in this market, I thought I'd seen it all, and that's what makes it fun, is you've never seen it all. So over the past few weeks, yes, we've seen some volatility in the loan market. If you look towards January and February, over 60% of the loan market was trading over par. And when that happens, we don't have a lot of call protection in our market. We're getting our loans are getting repriced constantly. Now, really a very small percentage of our market is trading anywhere near par. And it's become more investing and trying to find opportunities where we can not only collect our coupon, but also have some principal appreciation as well. So the volatility has been in the loan market. We've seen, retail flows were really strong at the beginning of the year. And then as the market changed post-Liberation Day and even leading up to it, we saw retail flows come out, and that created some pressure on pricing. But to me, that's where kind of the opportunity comes in, to find different opportunities to reposition the portfolio and, have the research that we do on a fundamental basis. Really, this is where we think we can really shine kind of going forward.
I'd love to touch on that a little bit. Just again, the size of the team and the resources that you have available to you. Of course, we in Canada represent a relatively small portion of all of the assets that your group runs.
Yep.
Again, north of $50 billion in Canadian terms. So could you speak to some of the different teams and resources that you leverage and work through these more difficult times and times of opportunity in the loans market?
Sure. So I like to talk about, I've been in the high yield group or the high income and alternatives group is kind of where our team is based out of Boston. I've been in that group for 30 years, and I've always talked about us being this like small boutique shop within this massive company of Fidelity. So what does that mean? So we've got, the $35–40 billion of US dollar loan assets in our group, but we're also part of the high income and alternatives, which is over 100 billion US issuer that invests in not only loans, but high yield bonds, preferred, converts, and equities. So we're investing up and down the capital structure of these credits. And we really believe, from a loan investor side, if I'm at the top of the capital structure of a company and our analysts are covering the entire capital structure, understanding how the rest of the market is seeing what's beneath us is super valuable from a credit protection and a collateral perspective and that sort of thing. So we've got 25 analysts who are working from an industry perspective, analyzing these credits for us on a day-to-day basis. So we've got analysts covering tech and telecom, software, healthcare. They're the industry experts for our group on the high yield side. But I also get the benefit from being in Boston and having thousands of companies come in every year to meet with our equity team. I get to access our equity research and our fixed income research worldwide. And what this does as a fundamental investor like myself and what my team like to do, we look at each credit individually, and this helps us to build a real mosaic of what's going on in the market. So not only are we talking to the companies that we're lending to on a regular basis, but we're also talking to their customers, their competitors, their suppliers. They're all coming through our doors all the time. So we have just an unbelievable amount of information flow coming to us to help us to make the right loans. Because in the end of the day, this is a market where you can really win by not losing. That's how you win. We're capped. Our upside, we have really little call protection in loans, so we're kind of capped at par. You make a good loan, you make a loan at $1,000. You're hoping to get paid $1,000 plus your coupon until they pay you off. If you're wrong, if you make a mistake, you could only get $400 or $300 or $700. But I can't make up that loss by buying another loan that's only capped at par. So you really have to focus on making the right credit calls, and that's where we think the fundamental research and that whole network helps us to build mosaic to put together really solid portfolios over time.
No, it's really interesting, and there are just so many different teams that you can lean on in these different situations. And I know one of those groups focuses a little bit more on some of those tougher situations when things don't go quite to plan, and the special situations group. So could you maybe share a little bit with our audience, who they are and how they add value to the investment process?
Sure. So I talked about winning by not losing. And the one thing I will always tell any investor that I get in front of is that when you're lending to as many companies as we are, when you have such a big platform, we will have mistakes. There will be things that go wrong where it's either we may have missed something on the fundamental side, or something changes overnight. Tariffs come, and all of a sudden a business model that you thought was going to generate 100 million in cash flow is now doing 50, and the world changes. What happens in those situations? Well, we get our analysts together, and the portfolio managers and I get the analysts together, and we try to figure, okay, this loan is traded down. What do we do? And then we bring in our special situations team in some situations. And this is a team we've got 3 lawyers on staff. And one of those 3 lawyers will kind of take the lead and become our face in the market. And what's happening in today's world is that as loans are trading down, groups are forming of holders to protect ourselves in these types of situations, to make sure that we lent money to this company. We need to get as much value for our shareholders as we possibly can in this type of situation. And that can mean negotiating with the private equity sponsor to come together and put together a new deal. It could mean trying to force a company into bankruptcy and taking the keys to a company, because as I said before, we're secured by the assets. We should be paid first. But driving that value is the job of the special situations team. And part of the good part of being Fidelity and being a big shop is that in a lot of these situations, people may have read about liquidity management exercises, or LMEs, in our market. In order to have a seat at the table, in order to protect yourself in a lot of these types of LME type situations, you need to have size and scale. And so the problem is, if you're going to make a mistake, you got to be big in that credit to protect yourself. And typically when we're in a credit, we're usually big, so we have the scale. But the other benefit that we have with our special situations team is that I've been working with 2 of these 3 lawyers for over 20 years. We've been in the group together. They are they're fantastic at what they do. And there are times where we may not really have enough scale or size in a certain credit that's going through one of these situations, but the other firms and the other lawyers are asking that we get included into those teams because of the expertise that we can bring to the table in negotiating these things. So the other thing that we have is, because of our scale and size, the lawyers are actually looking out for us as well, because they want to take care of Fidelity, because when the next deal comes down the road, they know that we might be big in something like that, and we can help get them onto that credit, and they can earn fees from that as well. So there's a benefit of the scale and the size, and the lawyers that we have are they've been doing it so long, they're like the voice of reason in the market, and they really understand how to drive value and where the pinch points are in a lot of these credits, and they're just a tremendous asset for us. And I'm going on too much, but the one other thing that they really do is that when we get into these sticky situations, these types of situations can be in a tremendous amount of time. They can take a tremendous amount of time, weeks, hours, all the time. The lawyers will take that over, and they'll allow myself and Kevin and Chandler, the co-portfolio managers on all these loan strategies, to focus on the other 400 names in the portfolio and bring us in when we need to know, and not have us be so focused on 5 or 6 credits in the portfolio. We can still kind of watch over everything else going on, with the understanding that we've got real value, real insight helping us drive value on the other side.
Well, it's so interesting to hear.
A lot of smaller firms just don't have that.
Well, and that's it. It's so interesting to hear just how the resources available to you, the size of the team, the fact that Fidelity is such a big player in this market that frankly doesn't really exist all that much in Canada. It's mostly US centric, and how that really is a differentiator for you. I am curious, we get a couple audience questions coming in, and private debt and private credit is certainly an area that gets and has gotten a lot of attention in recent years. Could you maybe speak to whether you do at all kind of overlap between the two and work with your high income partners and any kind of private credit deals as well?
Sure. So a few years back, Fidelity actually got into the private credit business, and that private credit business is under our high income and alternatives umbrella where I sit. And this is a team based out of Chicago. And we have regular interaction with that team on a weekly, daily basis. I was talking to the guy who runs the team. I was in the office yesterday, and we were talking about what was going on in our respective markets just yesterday. And the private credit market has seen tremendous amounts of growth. Some of that growth has come at the expense of the BSL market, or the market I'm in. There's basically been some deals that may have gone to private credit that I wish I had seen. And then there are other deals that are just too small that we really wouldn't have been interested in anyway. But the private credit market has been great for our market. It's given some of the companies that have struggled in our market to get refinancing or get deals done. It's another outlet for them to go to that wasn't there 5 years ago. So we've seen some big loans in our market leave our market and go to that private credit or direct lending market. But we've also got a pipeline of deals coming from the private credit market into the BSL market as well. And the nice thing is, because we have that team in Chicago now, when those loans come from the private credit market into our market, most of the time our team in Chicago has looked at it. They have a relationship with the management team there. They have a relationship with the sponsors. And when those deals are coming to us, we have a good understanding. We can get a really good understanding of where they're coming from and where they're going. So it's been a win-win for us to kind of grow in that market and benefit from it as well.
And all these resources, again, are feeding back into the floating rate high income fund that you manage for Canadian investors. But I think also interestingly, you manage, maybe for some listening today, not directly, but more so indirectly through other multi-asset class solutions, multi-sector fixed income funds, for instance. But could you maybe just talk to us a little bit about the fund itself and the strategy that you run for Canadian and many US investors?
Yeah, so we have $35 billion, call it US, under management. And we have a CLO business, which is run separately. It's part of the group, but it's run with a little different. But basically what we're doing is we are lending to non-investment grade companies with a fundamental long-term view in mind. So we tend to be overweight the single B space of the market because we think that's where we have the most advantage. Because of the size and depth of our team, we can look at some of these single B names, $500 million and above, and we can really give it attention because we have a really big team of analysts, where a smaller shop with maybe 3 or 4 analysts just can't focus in on all those names as well as we can. So we like fundamental research. We invest for the long term. We don't make macro calls. We don't try to call interest rates or anything like that. We look at each individual company from a bottom-up basis and try to decide over the next 3 to 4 years, will it be able to withstand cycles, seen and unseen type risks, And at the end of the day, will they be able to pay us back? And is it a good risk reward relative to other options in the market? And kind of the way we do it is if we got 25 analysts and they each have like 3 or 4 good ideas, and we like those ideas as a co-portfolio managers, those, 50, 75, 100 names will be the core of what's in our portfolio. We want the best ideas of our analysts and, with good fundamental outlooks over a long term is kind of how we focus in on things.
I think it'd be great if you could share a credit story or two with our audience that really kind of paints the picture of how this process plays out in real time. Do you have any stories
Sure.
that you could share with us?
Sure. Well, if you look at our portfolios across the board, and if anyone's ever heard me speak before, they're going to have heard me speak about Bass Pro Shop. We've been investors in that name for probably 15 years. And for those of you who don't know, Bass Pro Shops is an outdoor retailer in the U.S. They also own Cabela's, which is a hunting retailer, kind of U.S. massive, beautiful stores. And it's owned by one guy. His name is Johnny Morris. And we really started to grow our position in Bass Pro Shops many years ago when Amazon was just starting to take off, and everyone thought retail was going to go the way of the dodo bird, and no one was going to shop in stores, and we were all going to get our boxes delivered and everything done by Amazon. And we started to look at Bass Pro Shops, and we realized, our analyst did a ton of work on this thing. He said, realize people drive 2 hours on average to get to a Bass Pro Shops, and they'll spend 2 hours in the store, and 75 to 80% of what you buy in Bass Pro Shops you can't buy online. And it was more of an experiential type environment. And we looked at founder-led company who, I liken him to kind of the Walt Disney of retail. He just had a vision. If you've been into any of his stores and how he puts it together, they're just amazing, amazing boxes. And we thought this is different than JCPenney or, Kmart or any of these other kind of bad retailers that just kind of weren't really differentiated. So we actually started to buy a lot of Bass Pro Shops when we were getting, the coupon at SOFR plus 550, and we thought this is great. And slowly but surely the market started to catch up, and then Bass wanted to buy Cabela's, which, if you know about Bass Pro Shops, they're very strong in fishing. Cabela's was very strong in hunting. Bass was great on the merchandising side. Cabela's had a great credit card and loyalty program, but the thing was they were competing against each other. You build the Bass Pro Shops, trying to build Bass Pro Shops here, and Cabela's would build one 15 miles away. But by buying them, they could create a ton of synergies, take the best from both, stop building on each other. And this was the type of deal where the market was like, wait, Johnny, you're taking on too much risk. And we looked at it and said, this is fantastic. With all the synergies, they don't have to grow revenues, and they'll generate tons of cash and improve the thing. And we layered in more. And we continue every opportunity that we find where something like a Bass Pro Shops, it was just, now the story has played out. It's become our biggest holding. And we've developed, we like to tell the companies that we invest with, like we've been with Johnny Morris for 15 years. And we say to John, people like Johnny, we like founder-led companies where we can say, hey, we really like your business model. We understand what you're trying to do. We're going to start with you today, and we may have $100 million invested in you. But as you want to grow your business, we're going to be there. We're going to be a partner with you over time, and we want to grow with you, and we want our position size to grow with you. And you look at something like a Bass Pro Shops, and we're hundreds of millions of dollars invested in Bass Pro Shops. And what we really love is that, unlike a lot of these private equity firms, you can find a guy like a Johnny Morris who feels it's their duty to pay you back. That's the best part about it, is he wants to pay us back. It feels like it's like a moral thing to him, and that's the type of people you want to lend to. But you don't get access to Johnny Morris. You don't go to his resort like we were earlier this year and sit down with him and have dinner with him and his wife without the heft of being at Fidelity, where you've got that checkbook to say, hey, you need to pay attention to us because we can drive value for you.
No, it's an excellent story. There's certainly Bass Pro has a presence up here in Canada. You see the hats all over the place as well, and they certainly
Everybody do all your holiday shopping, presents, everything. Bass Pro Shops. That's what we do.
There you go. Well, we've only got a couple minutes left. I do want to chat a little bit just on rates. Again, as rates have risen over the last few years, it's been a pretty good market environment for loans. What's the outlook for rates, and do you think loans can still work in the environment we're in today?
Yeah, I mean, so it's a rates rising is a catch-22 for the loan investor, right? Because the good news is your base rate goes up, which is good for you. You're getting more income. On the flip side, the company is like, oh, this stinks because I got to pay more interest and my credit actually gets worse because interest rates have gone higher. And if we haven't hedged it, our free cash flow goes down. So, as rates were rising originally, it was like, okay, things are going fast. Can these companies kind of maintain this? Can they survive in a higher rate environment? We did a lot of work to figure out what companies can and can't, and we reacted to that. Now that rates have kind of stabilized here, and it's going to be, can loans work? The one thing we don't try to do is predict where rates are going. I have no idea. I'm not going to do it. If I knew it, I wouldn't be standing here investing in this market. What we do think is that if you kind of look at the dot plot, if you look at the curve, if short rates go down 150 basis points over the next couple of years, you're still getting kind of mid-single digit type coupon returns for loans. That still seems pretty good to us relative to the risks that we're taking. So can it work in kind of a declining rate environment? Yes, I think it can. And I also think what we saw when rates shot up quite a bit is that these companies are pretty resilient and they understand that, hey, we've got to figure out other ways to save that money that we're going to be paying out to the investors as well. So we feel pretty good about the ability for loans to work in kind of almost any environment.
Oh, it's great to hear. And I realize we're running out of time here. So do you have any final thoughts that you'd like to share with the audience joining us today?
No, I think when you invest in the loan business at Fidelity, you're going to get someone like myself who's got close to over 30 years experience in the high yield market. My two partners, Kevin and Chandler, are very experienced. And what we love to do is find good credits to lend to where we can get paid back. And if you take a long-term view over this market class or in this market, buying loans at 95 cents, this is known as the par loan market for a reason. Loans want to trade at par. And anytime you can buy loans at a discount, it's, history would show that it's usually a pretty good trade. You just have to be patient. And over time, we're going to see that pull to par for loans. And if you can buy them at below par, this is always interesting. And we love doing what we do.
Well, Eric, thank you again so much for your time today and for joining us on FidelityConnects. We really appreciated the conversation. Again, I think the audience has learned a lot more about a market that, again, isn't all that prevalent up here in Canada, but has a pretty big impact for everyone in the funds that they may hold, either yours directly or some of these other multi-asset and multi-sector fixed income mandates. So thank you very much.
Really appreciate the time.
Thanks for listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.